What's up, everybody? My name is Joe Brown, and this is Heresy Financial. Some strange things have been going on with bonds, especially today, but over the last couple of weeks. Bond yields have just been plummeting. This has left analysts perplexed and investors wondering, why in the world are bonds tumbling? We're seeing some fantastic cases of narrative fallacy taking place all across mainstream media. So today, we're going to look at why bond yields are dropping, why stocks are dropping, and what I think is the real reason behind it. Ready? Let's dive in. So interest rates have been falling recently, which is kind of odd considering the role that interest rates play on inflation. In general, they act as either a gas pedal or a brake pedal on the engine of inflation. If interest rates are dropping, that's like hitting the gas pedal. If interest rates are rising, that's like hitting the brake pedal. And the main reason for that is because interest rates going up makes debt more costly. When debt becomes more costly, you start to have deflation take place because deleveraging must happen in a rising interest rate environment. As debt gets more expensive, it gets harder to get your hands on new money, and it becomes costlier to maintain existing debt. And so deleveraging happens as a natural consequence of rising interest rates, which that deleveraging removes money. It contracts the money supply, which is deflationary, has deflationary effect on prices. Conversely, lowering interest rates is like a gas pedal for inflation. When you lower interest rates, it makes debt easier to get. It makes the cost of existing debt cheaper and has an expansionary force on the money supply, which has inflationary impact on prices. So recently we've seen some of the biggest inflation numbers in 10, 20, 30 years. As a result of that and some talking about tapering, last month we saw a spike in interest rates. But now it seems investors and analysts alike are perplexed because interest rates have been dropping again. And this is kind of the last thing that you would expect to see, because interest rates are supposed to be kind of self-regulating against inflation. If the money supply increases, interest rates would naturally rise in order to kind of offset that. The reason being that if inflation goes up, that means the purchasing power of money goes down over time. And so if you're going to lend money out, you're going to demand at least enough of an interest rate to match inflation so that you don't lose in real terms. Well, over the past couple of weeks, real rates have moved steeply negative, which is not free market activity. This has led the mainstream media to blame things like fears about COVID and an unexpected increase in jobless claims and full faith in what the Federal Reserve is saying and doing as reasons why interest rates might be dropping. And always remember, interest rates dropping, that's just a sign that people are piling into bonds. Driving up the price of bonds drives down the yields. Well, here's what I really think is going on. Number one, banks are hungry for collateral. But number two, the Federal Reserve is buying a lot of this debt. Just 2 weeks ago, the Federal Reserve added more to their balance sheet. They were buying bonds at a rate that was faster than they have in the last 3 months. And we all know who's been the one that's been out there saying more than anybody that this inflation is transitory. And the only reason an investor would buy a bond that has a real negative rate is if they have an expectation that inflation will crater, that we'll see deflation, and that right now you're buying it at a real negative rate, but very quickly it will be a positive rate. They can talk about decreasing their asset purchases in the future all they want, but as of right now, they're buying and buying and buying and buying and buying some more. Now, we've also started to see some volatility in the stock market, which if you saw my video, it was probably 2 weeks ago now, on sell signals starting to pile up in the market everywhere. This is to be expected. When stocks just go up and to the right for so long, you'd expect to see at least some volatility. And to the extent that investors are selling stocks because they're fearful of a top and fearful of a bear market or a correction, at least some of that money is going to make its way into bonds. Now, the key takeaway here that I want to make sure is very clear to all those deflationistas out there. Stocks dropping right now and interest rates falling is not indicative of the transitory inflation story being true. It's not indicative of a deflationary death spiral coming. Interest rates decreasing are a gas pedal for inflation. Interest rates increasing are the brake pedals for inflation. The very fact that we're seeing interest rates drop right now means we're more likely to see more inflation in the future because we're not getting the free market, the natural brake pedals thrown on inflation like we would without intervention. You can't put out a fire by dumping gasoline on it, and you can't stop inflation by lowering interest rates. But if the Federal Reserve has a hand in helping rates go back down right now and pushing them lower because they're buying extra bonds, why would they do this? If they're so keen on pushing this inflation is transitory narrative, you'd think that they'd want to make sure that inflation is actually transitory. So why would they do something that theoretically could make inflation last longer and be more extreme? I've said it once, I'll say it 1,000 times more. The country, both corporate America and the government, cannot afford higher interest rates. Higher interest rates makes the government and corporate America insolvent, bankrupt, default, done. There's too much debt that needs to continuously be rolled over. And if you have to pay off your old credit card that had a 0% interest rate with a new credit card that has a 10% interest rate, and you are already maxed out and you couldn't afford your payments with no interest, and now you have a 10% interest payment, you're bankrupt. You can't pay your bills. Same thing with the government, same thing with corporate America. So the only way to keep kicking the can down the road is to keep interest rates low, keep real rates deeply negative, because the Fed would much rather risk hyperinflation than get anywhere close to a deflationary death spiral. But what do I know? I'm just a guy on YouTube, and time will be the true judge and tell us whether or not the ivory tower elites at the Eccles building are truly incompetent or brilliant geniuses. I know what I'm betting on. As always, thank you so much for watching. I really appreciate you guys. Have a great day.